Let's be honest, you can't scroll for 2 minutes without seeing a headline screaming about a 2026 housing market crash. They'll tell you a full-blown 2008 style catastrophe is lurking just around the corner. But what if the real story isn't in those clickbait headlines? What if it's buried in the data? That anxiety you might be feeling about buying, selling, or just sitting on the sidelines could be based on a whole lot of noise and not a lot of facts. What if I told you that the people who analyze this market for a living aren't calling for a crash at all? In fact, most major forecasts predict something entirely different, and understanding that difference is your key to success. In this video, we're going to ignore the panic and shut out the noise. We're going to look at 5 critical data-backed metrics that reveal where the housing market is really headed in 2026. By the end, you'll know whether you should be scared or strategic. The last few years in the housing market have been anything but normal. We've seen chaos, record low interest rates, buying frenzies, and then a sudden, jarring halt as rates shot sky high. It's been volatile and, frankly, exhausting. Many people I talk to every day feel like they have financial whiplash. They're terrified of buying at the top, only to see the market collapse like it did in 2008. So let's get one thing straight right away. A nationwide 2008-style housing crash in 2026 is highly unlikely. The basic structure of the market is completely different today, and we'll get into exactly why. Instead, what major analysts are describing is a great housing reset, or a return to a more balanced housing market. This isn't a crash, it's a normalization. It's a move away from the unsustainable frenzy of the pandemic toward a market that is slower, steadier, and in many ways, healthier. But that doesn't mean prices can't dip in some areas. They can, and they probably will. The story of 2026 isn't about one single national market. It's a story of hundreds of local markets, all moving differently. Your ability to navigate the next couple of years depends on understanding which story your town is telling. So let's dive into the 5 data points you need to understand to see the real picture for 2026. The first and maybe the most important data point is the price of money itself, mortgage rates. For the average home buyer, nothing matters more. The wild ride from sub 3% rates to over 7% slammed the brakes on the housing market, and for good reason. It crushed affordability. So where are rates headed in 2026? The overwhelming consensus from economists and major forecasters is that mortgage rates will continue their slow, gradual descent, but they won't be returning to the rock bottom levels of 2021. Projections from institutions like Redfin and Realtor.com suggest the 30-year fixed rate will likely average somewhere in the low 6% range for much of the year. Redfin, for instance, predicts an average of 6.3%. Why is this so critical? Because it creates an affordability ceiling. Unlike the pre-2008 era, where risky loans let prices become totally unchained from incomes, today's market has a built-in break. With rates around 6%, there's a hard limit on how much the average person can borrow. This puts a powerful cap on how high home prices can climb. Prices simply can't run away when the cost of borrowing is this high. As a result, for the first time in years, forecasters expect wage growth to actually outpace home price growth in 2026, which is key to improving affordability over the long term. So what does this mean for you? It means you need to stop waiting for 3% rates to come back. They aren't on the horizon. The new strategic mindset is to budget for the new normal of rates between 5.5% and 6.5%. Your purchasing power will be defined by this range. This isn't scary, it's predictable. It means the market is moving from volatile to stable. A market with stable, albeit higher, rates is one you can plan for. You can run the numbers, understand your budget, and make a decision based on sound financials, not on a frantic race against falling rates. The key is to run your own affordability scenarios. Don't just plan for a 6.3% rate. See what your payment looks like at 5.8% and 6.8%. This is how you take control in a rebalancing market. The second critical data point is housing supply, or what we call inventory. The common narrative is, for prices to crash, we need a flood of homes for sale. And that's true. A crash requires a massive imbalance where supply wildly outstrips demand. But when you look at the data, that flood just isn't happening. To be clear, inventory is rising. After the absurdly low levels during the pandemic, the number of homes on the market has been ticking up. This gives buyers more options and a bit more breathing room than they've had in years. That's a good thing. It moves the market away from the desperate bidding wars of 2021 and gives buyers some negotiating power. However, and this is a huge distinction, rising from historic lows is not the same as a glut. We are still significantly below the inventory levels we saw before 2020. In fact, a recent Redfin analysis found that the U.S. home turnover rate in 2025 was the lowest in at least 30 years, with only about 28 out of every 1,000 homes changing hands. Why aren't more people selling? The reason is often called the golden handcuffs effect. A massive number of current homeowners are sitting on mortgages with interest rates of 4% or even lower. To sell their home would mean giving up that phenomenal rate and buying a new one at a rate in the 6% range, which would dramatically increase their monthly payment. For many, it simply makes no financial sense to move unless they absolutely have to. This creates an inventory gridlock. Sellers are reluctant to sell, and this scarcity of homes for sale creates a solid floor under prices. You can't have a 2008 style fire sale if there's a shortage of goods on the shelves. This is perhaps the biggest structural difference between today's market and the pre-crash market of the mid-2000s, which was marked by rampant overbuilding. Zillow even notes that new home construction is expected to have its slowest year since before the pandemic as builders pull back. For the strategic buyer, this means you should expect more choices and a better negotiating position in 2026, which is fantastic news. But you shouldn't expect a massive sale on every corner. The rebalancing of the market will be a slow grind, not a dramatic crash. Being strategic means being patient, ready to act when the right property comes along, and using the increased time homes are sitting on the market to your advantage in negotiations. So much of the fear around a 2026 crash is rooted in the trauma of 2008. It's a scar on our collective financial psyche. But when you look at the market's underlying structure, it's clear the system is now designed to prevent that kind of collapse. This brings us to our third point, the two-part safety net of strict lending standards and record high homeowner equity. First, let's talk about lending. The 2008 crisis was, at its core, a crisis of bad credit. It was fueled by an explosion of risky, exotic loans. We had ninja loans, no income, no job, or assets. Lenders gave mortgages to practically anyone who could fog a mirror with little verification. When those borrowers inevitably couldn't pay, it triggered a catastrophic wave of foreclosures. Today's lending environment is the polar opposite. After the crisis, regulations like the Dodd-Frank Act completely overhauled the mortgage industry. Lenders are now required by law to rigorously verify a borrower's ability to repay their loan. Those subprime, no documentation loans that fueled the last bubble are gone. Today's borrowers are some of the most qualified in history, with high credit scores and stable documented incomes. This means the risk of a mass default event is incredibly low. The second part of this safety net is homeowner equity. Because home prices rose so much over the past decade and lending has been so responsible, the average American homeowner is sitting on a staggering amount of wealth. Mortgage delinquency rates are near historic lows. Unlike in 2008, when many borrowers were underwater, owing more than their home was worth, today's homeowners are overwhelmingly equity rich. Why does this matter? An equity-rich homeowner doesn't just walk away and let their home go into foreclosure if they hit hard times. They have too much to lose. Instead, they can sell the property, pay off the mortgage, and likely walk away with a substantial amount of cash. This leads to an orderly sale, not a distressed foreclosure that dumps cheap inventory onto the market and drags down neighborhood values. This mountain of equity acts as a massive shock absorber for the entire system, preventing the kind of domino effect that defined the 2008 crash. So for the home buyer in 2026, what does this mean? It means you have to stop looking for history to repeat itself. The very mechanisms that caused the last crash have been largely dismantled. The market is simply more resilient. Waiting for a foreclosure crisis to provide you with a cheap home is a losing strategy, because the data shows it's just not in the cards. For years, the national housing headline was the only one that mattered. But for 2026, focusing on the national average is one of the biggest mistakes you can make. The real story, and our fourth data point, is happening at the local level. During the pandemic, the remote work revolution enabled a massive exodus from expensive coastal cities to more affordable, sunnier areas. Markets in Florida, Texas, and Arizona exploded. Prices in some cities shot up by 50% or more in just a few years. It was an unprecedented and unsustainable boom. Now, the pendulum is swinging back. Data shows those migration patterns are changing. Some of the same Sunbelt metros that saw the biggest booms are now seeing prices cool off as the cost of living soars and companies call employees back to the office. At the same time, we're seeing renewed interest in more affordable markets, particularly in the Midwest and Northeast. Cities like Hartford, Rochester, and Toledo are showing resilient growth. This is where the real risk and opportunity for 2026 lie. While national home prices are forecast to be relatively flat, with outlets like Redfin and Zillow predicting modest growth of around 1%, this average hides a dramatic split. For instance, a Realtor.com forecast noted that nearly a quarter of the 100 largest U.S. metros could see negative price growth, with most of them being in the South and West, the very markets that overheated. They are not crashing in a 2008 sense, but they are going through a necessary correction. For the strategic buyer, this is the most important data point of all. Your entire housing strategy has to become hyper-local. Stop paying attention to national news screaming crash or record highs. It's irrelevant. Your focus should be on your specific city and even your neighborhood. Are you in a formerly booming market like Austin or Raleigh? You may see more inventory and a real opportunity to negotiate. Sellers there no longer hold all the cards. Are you in a more stable Midwest or Northeast market? You may find that your market remains competitive as it attracts new residents. Your strategy will be completely different. You need to be tracking local inventory levels and price reductions. The national story is noise. The local data is the signal. Our final data point isn't about housing directly, but it's the wild card that could change everything. The health of the broader economy, specifically the job market. The housing market isn't its own little island. It's deeply connected to our financial security. Most 2026 housing forecasts, the ones predicting a slow reset, not a crash, are based on a crucial assumption that the economy will achieve a soft landing or, at worst, have a mild recession. Economists at major institutions like Morgan Stanley are forecasting a cooling labor market, but without the kind of catastrophic widespread job losses that would cripple the economy. This scenario would slow things down enough to help lower inflation and interest rates without derailing consumer confidence. However, this is the biggest if in the entire forecast. If the economy were to take a sharp nosedive into a deep recession, the housing outlook would change dramatically. Widespread job losses are the one thing that could override the other stabilizing factors we've discussed. People don't buy homes if they fear losing their job. A severe recession would crush buyer demand and could even force homeowners with lots of equity into distressed sales if they lose their income. This is the primary downside risk that economists are watching. While experts see a major recession as a possibility, not a probability, it's a risk you have to factor into your personal strategy. The resilience of the job market is what separates a housing correction from a housing crash. As long as people are employed, the inventory gridlock and the safety net of high-quality loans should hold. If that foundation cracks, the outlook becomes much more uncertain. What does this mean for you in 2026? It means your personal financial stability is the most important variable. Don't get so caught up in market predictions that you lose sight of your own situation. Before you even think about buying a home, you need to have a secure job, a healthy emergency fund, and a budget that can handle some uncertainty. Be strategic. Prepare for the most likely scenario, a stable job market, while being resilient enough to handle the less likely scenario of an economic downturn. So after looking at the data, where does that leave us for 2026? Let's quickly recap. First, mortgage rates are settling into a new normal in the low 6% range, putting a cap on price growth and slowly improving affordability. Second, the inventory gridlock is preventing the flood of supply needed for a crash. Third, the market has powerful safety nets, strict lending, and massive homeowner equity that didn't exist before 2008. Fourth, the national market is a myth. The real story is local, with some overheated areas correcting while affordable markets remain stable. And fifth, the economy is the wild card, but as long as the job market avoids a major collapse, the housing market should remain resilient. When you put it all together, the conclusion is clear. A nationwide 2008 level housing crash in 2026 remains highly unlikely. The fear in the headlines isn't supported by the core data. What we're facing is what Redfin has aptly called the Great Housing Reset, a return to a more balanced, sane, and predictable market. So no, you shouldn't be scared. You should be strategic. Being strategic in 2026 doesn't mean timing the bottom perfectly. It means understanding that the frenzied, anything-goes market of 2021 is over. It means recognizing that you now have more time to think, more properties to choose from, and more power to negotiate. It means focusing intensely on your local market data, not national headlines. And it means getting your personal finances in impeccable order. This new market isn't about panic and speculation. It rewards patience and preparation. It's a return to normalcy. And in a world that's been anything but normal, that shouldn't be a scary thought at all. It should be a welcome relief. Now I want to hear from you. What are you seeing in your local market? Are you in one of those cooling Sunbelt cities or a stable Midwest town? Are you planning to buy, sell, or wait in 2026? Drop your thoughts in the comments below and let's have a data-driven discussion. And if you want to stay ahead of the curve with analysis that cuts through the media noise, make sure you subscribe and hit that notification bell. We're dedicated to giving you the real story using the numbers that matter so you can make the smartest decisions for your future. Thanks for watching.